Away from the open of trading in Hong Kong, Shenzhen and Shanghai, we're watching the China show. I'm Heidi Stroud-Watts in Sydney, along with Avril Hong in Singapore. Our top stories this hour. Asian stocks track gains on Wall Street as Washington reaches a trade deal with Beijing, codifying the terms of their talks in Geneva. Commerce Secretary Howard Lutnick says the agreement will ensure US access to rare earths from China, the global leader in the industry. And Hong Kong property giant New World Development gets approval from creditors to restructure $11 billion in debt that's been straining its books. Take a look at what we're watching as we get into this final Friday session here in Asia. Pretty optimistic when it comes to broad benchmarks trading at the moment. We do have these consolidated bets of further Fed action and support. In addition, we've had sort of further pressure coming from the narrative from President Trump in terms of pressuring Chair Powell and talking about this idea that perhaps we'll have a sooner than expected time frame in terms of a more dovish replacement. All of this despite, of course, the Fed hawks still really circling to support the patience and caution narrative that we've heard from Fed Chair Powell. At the moment, though, we are seeing Asian stocks climbing. That momentum when it comes to risk appetite is building. A gauge of global equities touching a record high. We saw US stocks also showing that leadership on a record high as well. Some of these calming geopolitical concerns, some calm being restored to oil markets as well, also supporting. And of course, that de-escalation is trade is now where that renewed focus is, particularly with this accord or understanding being signed with China that involves rare earths. A lot of concerns are, of course, over the other trade truces and deals that are still very much on foot. Take a look at what we're watching when it comes to China, though, because we have had a lot of momentum trading when it comes to Chinese and greater China equities, I should say. The Hang Seng Index's best week since about March. We've also seen that turnover. The volumes are really telling us that perhaps we're seeing this revival of animal spirits in Chinese stocks as well. It's been a spell of low volatility and weak sentiment that could be turning, given that we're seeing the turnover when it comes to mainland stocks are highest since April 10th. That was, if you recall, that sell-off being triggered by US tariffs. And a lot of this coming down to perhaps, if not optimism, at least some calm when it comes to the trade front.
Yeah, a bit of a trade understanding at least. U.S. Commerce Secretary Howard Lutnick says Washington and China have finalized the trade understanding reached last month in Geneva. The deal sets out terms from earlier talks, but still depends on future actions.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
Our China correspondent Min Min Lo joins us now, along with our Bloomberg News Desk editor Jill Desis. And Min Min, let's start off with you. What do we know about this deal? Because it feels a little bit like, London was an extension of the agreement made in Geneva, and now perhaps this deal is a formalization of what we already knew. Do we have further details or substantive progress?
Yeah, it came as a bit of a surprise overnight when President Trump announced that he had signed a deal with China. But actually, so far, we haven't heard anything from the Chinese side to confirm this. So still waiting for details on that. But Howard Lutnick, Secretary of Commerce, had said that this is basically a codification of the agreements that were made in the Geneva talks and the London talks. We know that for now, tariffs will remain at 55% for China, inclusive of the pre-existing tariffs before Trump's second term. And it will be 10% on the U.S. The two sides had also agreed at the London talks that China will continue to send rare earths to the United States, and Howard Lutnick said that in exchange for that, U.S. will roll back some of these countermeasures. Among them would be rolling back the limitations placed on the export of ethane to China, and that's a chemical that China relies almost exclusively on the U.S. It's critical for plastics manufacturing. Already we are seeing some plastics factories in China really at risk of closure because of this. But aside from ethane, that is just one part of the equation, right? You think about what's top of mind. It's the chip curbs, the chips design software, jet engine parts. Are these going to be part of the deal as well? And we simply don't have the information now.
Yeah, critical sectors that we're watching. But Min, I wonder as well, have you seen recently some signs of goodwill gestures from the Chinese side, including on restrictions on fentanyl? And does that in any way inform whether they will actually deliver these rare earths?
Yes, we did see China quietly added a couple more ingredients of fentanyl into a restricted list. So China is making some effort to try to meet the demands of the U.S. So there is some level of goodwill going on. Although the Middle East conflict threw things into haywire again, China was extremely critical of U.S. actions in the Middle East. But meantime, I think it's quite interesting the timing of this deal actually front-running the other countries. We know that U.S. is still trying to come up with trade deals with all the rest of the world, with the deadline coming up on July 9th, less than 2 weeks from now. But with the Chinese deal, the deadline was in August for the temporary truce to expire, and yet the two countries had gone ahead and signed this deal way ahead of the deadline. So that's really interesting. But you look at how markets has been responding so far, you look at how futures were trading, actually pretty muted, and it shows that if tariffs had ratcheted up in August, that's really going to be a negative surprise. But I think investors are already pricing in the expectation that things are going to remain status quo. And that's what we are hearing now. It doesn't seem like there are huge breakthroughs from this deal. They are just putting into words and codifying whatever they had already agreed on. So not much actually has changed.
Yeah, we'll watch for the China stock market open today. Bloomberg's China correspondent Min Lo for us there. Thanks so much. Now, let's bring in Jill for a look at what else we're seeing in terms of trade deals with other countries. Where does this leave the likes of, outside of China, particularly when it comes to sectoral tariffs, Jill?
Yes, Ariel, I'm glad that you brought up sectoral tariffs because I think that's really the big question mark here that could potentially impact how exactly a lot of other nations, whether that be Japan, India, even the European Union, how exactly they negotiate deals with the United States over the next couple of weeks. It really is that big question. Here's the reason why. So first of all, we're all kind of waiting for this July 9th deadline. That's when, Trump certainly would like a lot resolved on the reciprocal tariff front. Remember, that's his big Liberation Day tariffs. He gave everybody 90 days to negotiate new deals. We've heard just recently from Howard Lutnick, talking about how they want to divide countries into various buckets as they start to resolve those deals. The issue is that sort of parallel with those reciprocal tariffs, remember, those are the tariffs that were country by country that Trump really handed down via executive order. Parallel to that, obviously, we've got these reciprocal tariffs. These sectoral tariffs, ones that have already, been in effect, looking at steel and aluminum, auto parts, that kind of thing, and along with some others that could potentially still come into effect. The U.S. Commerce Department is investigating potential sectoral tariffs on everything from semiconductor parts to pharmaceuticals and such. So that kind of is still looming there. I think there's also just the sort of conventional wisdom that anything that's implied under the sectoral tariffs, Section 232 is really that part of U.S. law that would apply under, may be much more difficult to challenge or repeal domestically compared to, say, the Trump executive order tariffs, which I think are still a bit up in the air. So if you're any of these countries, if you're India, if you're Japan, if you're the EU, if you're Vietnam, I'm not really sure what motivation you have to actually negotiate something with the Trump administration ahead of that July 9th deadline, if there's this fear that you could be giving away a lot of your leverage, a lot of your negotiation power, signing something that's this deal, and then you've got other sectoral tariffs that come into effect. I just want to give you one example here. There's a lot of questions over that UK partial deal that was signed, just a bit ago, because the UK kind of comes in, they make a deal with Donald Trump. They're still subject to some of those big steel tariffs that are come under that sectoral angle here. So I think, big picture here is that there's a lot of confusion over, as we ramp up to that July 9th reciprocal tariff deadline, how exactly these countries are going to play ball when you've got, that looming threat of other industrial tariffs that could be hanging over them still.
And it is that clustering of confusion and different trade jostling right as we head towards that deadline. Indian negotiators are actually in the US at the moment. And to your point, there is a sense that India is, amongst other parties, kind of digging their heels in.
Yes, I think that when you look particularly at some of those really key U.S. allies, I think some of whom were wondering, why they were hit so hard with some of these reciprocal tariffs in the first place. I mean, India, Japan also, I think, is a really interesting one to watch. Obviously, you've got India on the ground trying to make a deal there. I think Japan is also interesting because obviously a lot of those auto sector tariffs are really, really hitting, potentially Japan there. I think a lot of, Japanese automakers, manufacturers are really, really concerned when it comes to their it just really does leave a lot of questions as to what these deals are ultimately going to be. If you're India, obviously, you want to make a deal. You want to, be able to, get to a good place with the Trump administration. But when you've got the potential for more tariffs down the line after you've already got something done and dusted that could be coming to bite you, I think that makes negotiations very difficult.
Bloomberg editorial data there in Hong Kong, and we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong, as well as we see really investors are digesting this deal that has been signed between the US and China. This on the back of a pretty good run when it comes to risk sentiment in Chinese equities. This is the China Show.
And if we had a person over at the Fed that would lower interest rates a little bit, that would be helpful too. It's hard to believe this is on top of, we have to fight this guy. He's not doing the job. Each point that he keeps it up is the equivalent of $300 billion. $300 billion. So if he lowered it would save $600 billion.
President Trump there speaking at the White House earlier, putting pressure, more pressure that is, on Fed Chair Jay Powell to cut rates. Let's bring in now with some analysis Jenny Zheng, who's the Deputy Head of Fixed Income and APAC Fixed Income CIO at Allianz Global Investors. Jenny, great to have you with us. So really further piling on the pressure for Chair Powell on his part refusing to cave to that pressure, right? And even as sort of, the dovish candidates are circling him, we're seeing that support from his fellow hawks, from Thomas Barkin to Mary Daly to Susan Collins, all kind of reiterating this path of patience going forward. Do you think the political kind of spectacle changes the risk when it comes to that rate path and inflation path forward?
The Fed rate cut actually is at the core of a fixed income market right now. Now, if you look at the U.S. economy, the current status of the U.S. economy is showing that hard data, including the job unemployment rate, actually is softening, but it's not showing any imbalances. So it's resilient, but it's softening, it's moderating. And while at the same time, in fact, soft data, including consumer spending numbers, are improving significantly, in fact. Now, there's only one very strong reason for Fed. If they're going to cut earlier than the market expected, then it will be the inflation data, the very recent inflation data. CPI and the PPI actually has been surprised on the downside for 4th months in a row. So that will give Fed some excuse to cut if you really want to cut. But we really think that the Fed is going to be in a wait and see mode for the foreseeable future. And we really don't think Fed is going to cut in July. Now, again, we really think Fed needs to see a significant weakening of the growth numbers and the job numbers for them to cut. Then that will be towards the end of the year.
Jenny, does that suggest that you think that the gains that we're seeing in treasuries for, I think, a third week now, the sort of structural weakness that we see in the dollar might be overdone at this point?
The interesting thing is, we can talk about the potential path for both growth and inflation. One of the challenges nowadays in the market is that the visibility for near-term number, in fact, is quite low, particularly on the inflation side. I think on the growth side, we can have a little bit more visibility and conviction that seeing that growth is slowing down. But on the inflation side, given that the unaccessible, it's very difficult to analyze the inflation impact, particularly from tariffs tariffs, and we don't know. We don't even know what's going to happen in July the 9th, and we don't know what's going to happen in August. So inflation assessment is increasingly more challenging. So as a result, if you look at the Treasury market overnight performance, you can see it's rallied, yes, but also steepened. That reflects a few things. Number one, of course, it's reflecting the weaker data, and number two is to reflect that concerns the investors' concerns on the potential decline of independence of Fed.
Yeah, Fred, credibility really in focus here. I wonder what this means about the de-dollarization theme, what this means for investment flows into Asia.
Yeah, de-dollarization or not, if we look at the US dollar as a currency, on a PPP basis, despite the recent decline, it's not even that cheap. So cyclically, we could even see more pressure on weaker dollar. Structurally, then that actually fits into the structural thing that people are looking for diversification, particularly in Asian countries. What sets Asian apart is that Asian actually is the world creditor. So Asian has a lot of money, a lot of excess savings that invest in US dollar assets. Now Asian countries are looking for diversification. And then we see the first rounds of reallocation of capital that could slow down a little bit going into the summer, but may resume again once we started to see weakening of US growth numbers and maybe even a pickup of inflation. Then that will strengthen, reinforce that structurally weaker dollar narrative.
And it also, I think, enhances the appeal of the yuan. At Lu Jiazui, there was a lot of talk about yuan internationalization. Jenny, what do you think is the best way to capitalize on that trend?
Absolutely right. With people started to reassess the dominance of U.S. dollar, and in Asia there is a natural potential alternative, which is yuan and RMB. And if we look at the past decade, the CGB performance actually outperformed both U.S. Treasury and the German bond by a large margin. That increased the credibility of CGB as a potential alternative as a safe haven assets. Now, if you look at what happened recently, I do think that the China is also taking the opportunity of a weaker dollar trend to further liberate its capital account, evidenced by the most recent announcement of the Payment Connect program last Friday. I think it was announced last Friday.
Jenny, just wondering as well, when it comes to CGBs, how do you think the PBOC is thinking about yields? Because it's been relatively range-bound of late.
Yes. So China's overall yield level, it also depends, at the end of the day, still depends on growth and inflation. Well, with all the tech talks, which are all good news, in fact, the economy still struggles. And the government is not able to reflate the economy as what they wanted at the beginning of the year. So we expect even more fiscal spending, fiscal stimulus to come, probably in the July Politburo meeting. So which means you still have a deflationary pressure in the economy, and you can see that the growth number continue to be moderating as well, particularly if we do not see a continuous stabilization of the property market that would put even more pressure on the growth perspective of the economy. All that points to a lower yield from a 6 to 9 months perspective. Now, the thing is, from a central bank's perspective, you do not want to see yield coming down too fast, like what we see in fourth quarter last year. You want to see that the yield grinding down slowly so as to support the economy. So we think that CGB yield will continue to go down. Yeah.
Yeah, the refresh steepening in treasuries, how frustrating is that, particularly when it comes to the longer end of JGBs?
The JGBs, sorry.
Yeah, so there would have been some hope for curve flattening. That's clearly not what we're seeing when it comes to treasuries. Does that mean that we're not going to see much love for the longer end for JGBs going forward?
Yeah, it's interesting you mentioned that. In fact, in our view, in most of the parts of the world and the fixed income market, we think a steepener is a clearer way of expressing a duration view. If you think about the U.S., Having said that, that lower end is driven by Fed cut, and we started to see weakening of economic data, while the longer end is more driven by the fiscal concerns and also the concerns on the independence and the credibility of Fed. So it's actually easier to play that as a steeper curve. It's the same for JGB. Now, there's only one market, very interesting, and there's only one market which is different, which is the CGB market. And we see CGB market actually flattened compared with all the steepening trend that we've seen in the other global fixed income market, which is very interesting.
All part of investors looking for alternatives outside of the U.S. Jenny, great to have you with us. Thanks so much. Jenny Zhang, Deputy Head of Fixed Income and APEC Fixed Income CIO at Allianz Global Investors. Let's take a look at how Chinese markets are shaping up. Of course, the one stock that we're keeping a close watch on is Xiaomi after its new SUV models got really strong pre-orders within minutes of the launch. So we're indicated higher 8% in Xiaomi. Other than that, looking like a mixed start to both Hong Kong and Chinese trading. Watching out for dollar China as well. It's overall been nudging lower. Plenty more ahead. This is Bloomberg. You're watching The China Show. A couple of stocks that are in focus, including Xiaomi, after it released its latest SUV model. Of course, this is a company that's been breaking into the EV space, and we already saw how stocks were near that record high. I think this 8% climb at the open would take it to that level. Certainly, this is against the backdrop of the pre-orders for the YU7 coming in strong, I think stronger than some estimates, 200,000 orders within minutes of its release. Other than that, keeping an eye on New World as well, as we're hearing that it's secured 100% approval from all banks for an $11.1 billion loan refinancing. That's according to Bloomberg sources. And this really caps, I think, a month-long negotiation for a debt package. So seeing it higher as well, Heidi.
Take a look at what we're watching pre-market. Of course, we've seen quite the run when it comes to the Hang Seng Index, the best week since about March. We'll be watching to see if that momentum can be sustained, particularly now that we've had this trade deal being secured or trade understanding being secured that removes potentially some of that volatility. This is what China futures will firmly trading to the upside. Also watching that dynamic of yuan strength and Hong Kong dollar weakness. Welcome back. You're watching The China Show. We are counting down to the open of markets across Greater China. We're expecting that upward momentum given that US stocks continue to trade at those record highs overnight. Global equities also touching a record high. This as a renewed focus away from calming geopolitics in the Middle East returns to the bread and butter for these markets of trade as well as the Fed. The momentum when it comes to Fed rate cut expectations is building. We're also seeing that pressure from President Trump, the political pressure from government on the Fed chair Powell as well as the Fed really building there as well. We'll talk about an earlier than expected selection of his replacement. All of this feeding through to quite a bit of optimism when it comes to risk sentiment, particularly as we have seen the best month for the Hong Kong Hang Seng Index since about March. So April, just take a look at what we're seeing at the moment at the open.
Yeah, I mean, as you say, it's some of that trade optimism, and for Chinese markets also that optimism that authorities will continue supporting the tech sector. We've seen mainland markets doing fairly well. They hit it for the best week since early March, and some of the bullish indicators include the finance stocks that have been outperforming. Flip the board. Aside from that, we also saw the Hang Seng. I think it's on track as well for its best week since March. And if you can take a look at this next page, we'll show you as well what we're seeing in terms of dollar China, in terms of how the PBOC has kind of been guiding the renminbi and supportive of that gradual strength against the backdrop of dollar weakness. But of course, the stocks that we are watching today would include the likes of Xiaomi after its SUV launch, but also New World development, some signs that that debt package is well underway. Aside from that, with geopolitics in the mix and rare earths, in focus, given what was eked out between the U.S. and China based on the trade understanding. Let's flip the board and take a look at how they are faring as well. Of course, this has been a key focus, whether China is going to be delivering these rare earths that the U.S. sees as absolutely critical, seeing some upside when it comes to some of these rare earth stocks. Heidi.
Take a look at how markets are doing with a little bit more detail. Equities reporter April Ma joins us now from Hong Kong. So do we see this sort of sustained momentum at this point? And what are the catalysts for the next move higher or potentially a little bit of a retracement?
Yeah, I think we've definitely seen a huge difference from the days, the past couple of months, really, because now the lead gainers are those high beta names like defense, like securities companies, and of course today Xiaomi, which will inevitably bring up those names that have been on the auto supply chain that have been dormant for a couple of weeks now. So I think momentum is back. We've seen that in the pickup in turnover. Some of the worrying signs, though, is the fact that margin trades have not picked up. So it feels like the animal spirits are they're back, but not completely back. So I think the market momentum, in order to sustain, we'd have to see a lot more policy catalysts. I think what investors are talking about now, apart from the Politburo, which is late July, I think we also want to see a more of those birth subsidies as well.
Aside from maybe some support from authorities, what are you seeing in terms of valuations and the likes of Xiaomi, record highs, right? You know, that sense that maybe there's too much into this.
Yeah, so I think with the huge beat in the pre-orders last night, I think investors are also taking it with a grain of salt because a lot of these orders are converted from the SU7 orders. And also there's a lot of scalpers out there. So I'm not sure, or at least the people that I'm talking to are not completely sure that we can take that number at face value. But then also on the other hand, there's a lot more reason to be optimistic because this latest model shows that its foray into the high-end end of electric vehicles is now accelerating.
Bloomberg's China equities reporter April Ma there with the details. We are also getting a little bit more of a read when it comes to the broader economic outlook and how the economy is faring at the moment. Industrial profits for China just crossing the Bloomberg year to date. That year-on-year number for May seeing a contraction of 1.1%. Expectations were for a pretty meager gain of 1%, and it certainly reverses the gains that we saw in April of close to 1.5%. Year-on-year, that reading is a contraction of 9.1%, also reversing the gains of 3% that we saw in the previous month. So overall, that downside pressure when it comes to the broader Chinese economy continues, even as we see perhaps a little bit more progress on the external trade front.
Yeah, the macro backdrop does still continue to worry. We're seeing that weakening on the Chinese yuan as well against the backdrop of this data. But in the meantime, Bloomberg's learned that Hong Kong-based builder New World Development has secured written commitments from all the banks involved in its $11 billion loan refinancing. Our China credit reporter Trista Sinyi-Luo joins us now. So Trista, we're getting a sort of update from Bloomberg sources. What does this all mean for the builder?
Yeah, I think it means like we are one step closer for the builder to finalize deal. The builder has been spent the past couple months on this mega refinancing discussion, and right now there's just some paperwork done, and we're expecting that they will come soon. So it's actually good news for New World.
How significant is this mega refinancing then?
Yeah, I think this mega refinancing is crucial for New World as it will buy them some time. Once it complete, some borrowing that are supposed to be due this year and next year will be pushed back to 2028, which means that New World can still have some breathing room to try to improve their financial situation. But we need to remember that New World still has the highest debt burden among all Hong Kong developers here, and is still grappling with over 200 billion Hong Kong dollar of liability.
Yeah, so it's not quite out of the woods yet. I mean, what are we expecting in terms of coupon payments, for example? What should people watch out next?
Yeah, I think as for coupon payment, I think investors are largely expected that should be okay. But I think right now the attention has shifted to whether New World can close a new loan, which they're using is Crown asset Victoria Dockside as a collateral and trying to raise 15.6 billion Hong Kong dollar. I think investors are keen to see whether that deal could be closed. And we reported earlier that part of the proceeds will be used to repay the complete refinance. I think another thing investors are looking is whether the builder will do liability management exercise on its dollar bonds. We haven't seen any sign yet, but I think some bondholders are thinking maybe it's time for the company to talk with them right now.
Are there any implications for the broader Hong Kong market?
I think for New World, it's more exceptional as standalone case, although we know that the Hong Kong property market is still not good, especially on the commercial real estate side. But when you look at New World's major rival in Hong Kong, I think they're in a better position with less debt burden.
Bloomberg's China credit reporter Trista Xinyi Luo there. Well, New World is also